Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
My name is Steve Meizinger. I am presenting today as well as hosting, and I'm talking about how do option orders affect FX options prices. We, of course, give weekly webinars. I'm the host, and today the guest speaker, taxes, margin, and commission. Those are very important considerations, and prior to entering into any options transaction, you should consider those very important factors. Lots of strategies out there. Which one's best? You have to think about which is best for you. Buying a put, buying a call, those are the simple bearish or bullish strategies. You could do moderately bearish and even neutral strategies. Who trades the FX options market? Institutional traders, big banks, if you will, self-directed retail traders, and market makers. They essentially make up the market. Pricing models. Well, why would you care about that? Well, it helps all of us, whether you're an institutional investor, you're a self-directed investor, you're a spot FX trader that's looking to break into the options market, a market maker. You need to want to learn more about the options model. Why? It helps you understand that the model is based on the premise that exchange rates, I have stock prices, but you can substitute exchange rates, are random and cannot be predicted. If we believe that we can, and many of us do believe that, it seems to me that currency rates trend a little bit longer, if you will, than equities. So if you see these trends, the options market might be for you. Options values are based on a bell-shaped log normal distribution with a slight upward bias. And all the participants of the FX options market have access to pricing models. Each participant might use them differently. So what factors affect the FX options prices? Well, FX, the value, the pair value, days until expiration. I guess I should. So it's pair value, days until expiration, strike price, interest rate diff, and volatility. Probability of change. If you think about it, volatility, that's what we're talking about. Volatility, very important. The likelihood the exchange rate is going to move up by a certain percentage or down by a certain percentage. That's what we're trading. So when we're trading these option premiums, we're buying limited risk. And the premiums are determined by the marketplace themselves. So theoretically, the premiums are determined by models. The models price based on expected moves. So uncertainty has a huge impact in the currency market. Models are great, but George Kellenbach, one of the most famous statisticians of the 20th century, once remarked that essentially all models are wrong, but some are useful. Models help investors determine what should occur based on predefined assumptions. Occasionally, the assumptions may or may not be correct. Ultimately, supply and demand creates the prices. Models give investors an educated guess on what the prices should be based on certain assumptions. So it's theory and practice. You have market makers balancing their theoretical prices versus the actual market prices to balance their risk-reward exposure. Key point here, the difference between an option price, what an option price model would expect an option to be worth, and its real or its ISE value at any one moment is sometimes called skew. And I'm going to be presenting a separate class on skew in the next month or so, where I have some neat tools that have been provided to me by a company called LiveVol. And if you're interested, you should check out livevol.com. They have some great tools and a lot to do with volatility. And if you're trading the FX options market, you're going to want to learn more about volatility. So go and check out livevol.com. And again, I'll be talking more about skew in the next couple of weeks. I think it's about a month or so we're going to be posting a class on skew. Market makers' macro view of the market risk. What are they looking at when they're trading these currencies? They're looking at credit swaps, swapping IOUs for cash. We just saw this in the last couple of weeks. In fact, Jack Crooks has been predicting these swap markets might blow out, and he's been saying this for the last 5 or 6 months. And for those of you that have been frequently attending the webinars, you know that Jack's been talking about this. And what happened over the last 3 or 4 weeks? Well, the credit swaps on some of the Greek debt have exploded. So it's very interesting. Of course, you could look at corporate government bonds. So Greek bonds versus German bonds. Spreads are widening. You need to look at this. Spreads are widening. What happens? Well, then it's a problem because, again, there isn't a Greek currency anymore, and this is the problem for the euro. Hence, maybe a trading opportunity, although we've seen a pretty big move over the last 6 or 7 weeks. You have government bonds, emerging market bonds. Again, different ways to look at risk, the willingness for investors to assume the risk of default or reduce stability in more speculative regions in the world. On the other side of the coin, some people are actually saying that the emerging markets, because their debt levels, might be more serviceable than the old developed parts of the world, parts like Europe, the United States, Japan, that have tremendous debt relative to their expected growth. So this is all very interesting how it's going to play out over the next couple of months and even years. These options are here. They're available for you to trade anytime that you have a view. Foreign exchange volatility. Again, you can learn more about it here at the IAC. If you want to see a great site, go to LiveVol. You can type in the IAC symbols and learn more about how the volatility has worked in the past, so you can understand about exchange rate expectations, because that's what we're really talking about when we're looking at volatility. The demand for greater compensation by option writers indicates a lessened willingness to assume exchange rate risk. We've seen this recently, how volatilities have exploded in a couple. Brazilian real volatility has exploded for sure. And we want to keep our eye on, let's say, the Australian dollar, see what happens. Equity volatility. Implied option prices indicate option writers' confidence in the level of equity valuations. You might want to look at yield curves. And this is pretty neat. I took this from Bloomberg. And you could look at the rates of the U.S., Brazil, Australia, Canada, and the U.S. It's hard to see here, so I do apologize. What I was trying to show is that the U.S. rate, which is all the way in the bottom, the lowest rate, and as you move up the curve, you'll see that, believe it or not, the Australian rates are the highest, followed by the Brazilian rates. And, you know, you want to look at those currency pairs. So if you want to look at the AUM, for instance, that's the Australian dollar versus the U.S. dollar. But BRB, which is the U.S. dollar versus the Brazilian real, you want to see what people are being paid, or what kind of volatilities are out there. And you could relate that to risk, the Canadian dollar. The Canadian dollar trades a lot more like the U.S. dollar relative to, let's say, the Australian dollar. British pound also trades a lot like the U.S. dollar. And again, these correlations, quote-unquote correlations, don't last forever. They won't last forever, but they might create trading opportunities in the options market.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.